Hello everyone, welcome to the Tim Booker channel. I wish you all an enjoyable listening experience. Today, I will be interpreting a book for you, which is titled The Psychology of Finance. The author of this book, Lars Tvede, is a successful investment banker, fund manager, and financial derivatives investor. He is also the author of the best-selling book, The End of Economic Mania. It can be said that Lars Tvede excels at profiting from market trends. At the same time, he writes books to guide investors on risk management and self-protection. It's like a gambling master advising gamblers on how to win. As a result, this book has been reprinted over 50 times, and its global success is not surprising. The Psychology of Finance elaborates on a crucial point: the direct factors influencing financial market prices are the psychology and cognition of market participants. I will break down the essence of this book into 3 parts for you. 1. The 4 fundamental principles of financial markets. 2. What information is most valuable in financial markets. 3. How investor psychology drives stock market ups and downs. Let's start with the first part, the 4 fundamental principles of financial markets. Let me begin by recounting the famous Wall Street crash of 1929. In 1929, the U.S. stock market was in a 10-year bull market. Everyone was investing in stocks, believing that they could make money. However, on October 24, the stock market suddenly started to plummet. In just 2 weeks, $30 billion in wealth disappeared, equivalent to the total cost of World War I. The stock market crash finally hit its bottom on July 8, 1932. During those 3 years, the U.S. GDP was halved, 110,000 businesses went bankrupt, over 8,800 banks closed, and 17 million people were unemployed. Even Yale University economics professor Irving Fisher, who was once the wealthiest economist in the world and called the Wall Street prophet of the 1920s, couldn't escape. He lost his $15 million fortune in that stock market crash. In 1935, Fisher was forced into retirement by Yale University and died owing friends and family $750,000. Besides Fisher, the most renowned economist of the 20th century, Keynes, also faced near bankruptcy during that crisis. You might wonder why the most authoritative economists in the world suffered such dire losses. After the 1929 crash, financial crises of various scales continued to occur repeatedly, each with similar tragic consequences. Haven't people learned any lessons from these experiences? Perhaps there are mysterious forces at work in the capital markets that go beyond our understanding of financial theory. The Psychology of Finance summarizes 4 fundamental principles of these mysterious forces. The first principle is that the market leads the economy. This means that the stock market serves as a barometer of the economy and can anticipate economic trends. In general, during economic downturns, the stock market declines before economic indicators do, and during economic upturns, the stock market stabilizes and rises ahead of the economy. Why is it said that the market can anticipate economic trends? This is because investors who are deeply involved in industries have expectations of impending changes. If investors in a particular industry notice a decline in product orders for the industry leader, indicating reduced demand, they may sell the stock of that company. They may recognize the company's risk earlier than its management does. Conversely, if they see a company's order book overflowing in strong demand, they may buy the stock. This market insight forms the basis for the rapid response of the stock market. So, how far in advance can the stock market lead the economy? Research by Bruno Solnick, the first chairman of the European Finance Association, shows that the stock market typically leads the economy by approximately 6 to 9 months. In other words, when the stock market has been rising for 6 to 9 months, company sales and financial indicators begin to reflect the improvement. Of course, it must be mentioned that in reality, the stock market can be influenced and manipulated by human intervention, and it is often irrational, as Lars Tvede believes. Next, we'll discuss the second fundamental principle of financial markets: markets are irrational. In the 17th century, the Netherlands was the most prosperous capitalist country of the time. The Dutch upper class considered tulips to be a symbol of taste. Their popularity in high society led to a continuous increase in tulip prices year after year. During the peak of the craze, the price of a single tulip equaled that of a wine distillery. The prosperity of tulips in the Netherlands caught the attention of foreign investors. As soon as the prices dropped slightly, they rushed in to invest. Eventually, people became perplexed. How could the value of tulips be so high? Panic and collapse followed suit. In the end, the harsh reality was that tulips, which were once considered priceless, became worthless. Many people lost their fortunes, and the tulip bubble plunged the Netherlands into a prolonged economic depression. Afterward, the Netherlands fell from its position as the world's leading empire, and the center of European prosperity shifted to Britain. This is the famous historical tulip bubble, and what does it illustrate? It demonstrates that markets are composed of millions of individuals who, influenced by collective emotions, greedily buy and fearfully sell. The market is entirely controlled by people's fantasies, becoming hysterical. The collective irrationality within the market also validates the third fundamental principle of the stock market: predicting long-term economic trends is impossible. Why? Because of the butterfly effect. The butterfly effect means that a seemingly insignificant small action can trigger a chain reaction of massive consequences. In the financial market, there's a saying that an old lady selling a few bonds in Brussels could potentially lead to the collapse of the Japanese market. In other words, market developments are entirely unpredictable. Any tiny change can lead to entirely different outcomes. When stocks rise, everyone rushes in enthusiastically, and when stocks fall, people trample each other in fear. Human nature magnifies even small profits, small losses, or the slightest change infinitely. You can predict that the stock market will fall, but it's challenging to predict and to what extent it will fall because the economy is often influenced by minor details. Therefore, predicting long-term trends is futile. One of the greatest investors in history, Peter Lynch, also said, "Don't try to predict the stock market 1 year or 2 years ahead, it's simply impossible." Since financial markets are unpredictable, what value do economists and market analysts provide? Despite the unpredictability of financial markets, it is their research and analysis that strive to align psychological expectations in the financial market as closely as possible with the objective world. In fact, they often get it wrong. To overcome irrationality, market traders hope to use technical charts to discover patterns in price changes. However, technical charts are also a result of psychological effects. This leads us to the fourth fundamental principle of financial markets: technical charts are self-fulfilling. What does this mean? It means that technical charts are the result of people's trading behavior. For instance, imagine that the market consists of 1,000 well-informed investors, with 900 of them being technical traders who trade based on price charts, and the remaining 100 being value investors who trade based on fundamental analysis. Everyone is bullish, buying stocks, and the market steadily rises. However, when it reaches a certain price level, say, a previous high, all 900 technical traders decide it's time to sell. The 100 value investors are watching and waiting. Eventually, all 900 sell orders are executed simultaneously, causing the price to plummet. After some time, the market begins to reverse, and prices rise again. This time, the 100 value investors remember the previous lesson and decide to sell when it reaches the previous high. So, all 1,000 investors become technical traders, and they all start acting at the same price point. This is the self-fulfilling nature of technical analysis. Consider that there are only a few tools for technical analysis, and most people use the same technical analysis methods, taking the same actions. The end result is that they collectively drive the self-fulfillment of the patterns. Alright, with these four fundamental principles, we've covered the basics. Investing is a highly complex endeavor. Professional investors generally make more money than most participants in the market. The key difference lies not only in their financial knowledge and investment capabilities but also in the distance of information. Grasping truly valuable information is essential for making correct decisions. Now let's move on to the second part of the content: what kind of information is most valuable in the financial markets? According to Lars Tvede, there are primarily two types of information in financial markets: news and trading information. Lars Tvede believes that news has no intrinsic value in the financial markets. He provides various examples to demonstrate that the market often moves counter to news reports. For instance, a cover story in a business magazine might suggest that government bond prices will continue to fall, but in reality, government bond prices start to surge afterward. Similarly, a headline stating that stocks are still the top investment choice may be followed by a decline in stock prices and, 3 months later, the largest drop in history. Why does news often contradict market trends? First, people naturally assume that information published by the media must be accurate, but in reality, information obtained from public news can be ambiguous, contradictory, or even false. As the Prussian military theorist Karl von Clausewitz said, the majority of unfiltered information is erroneous and cannot truly reflect market trends. Second, the value of news is significantly discounted at the moment of release. As mentioned earlier, the market leads the economy. Before positive or negative news is officially announced, market prices already reflect people's expectations. Therefore, at the moment news is officially released, prices are often already at their peak or have hit bottom. Third, a plethora of complex news information can create stress and doubt in people's minds, leading to erroneous judgments in situations where they originally had confidence. In reality, the direct factors affecting financial prices are people's judgments and perceptions in the market, and the media cannot predict collective perceptions. Therefore, in Lars Tvede's view, news has little value for investors and can even be misleading. Relying on financial news to trade stocks is unlikely to be profitable. If you want to make money, you should focus on trading information from market participants. Market participants fall into two categories: institutional investors and retail investors. Retail investors are generally less savvy in the market, while institutional investors, on average, make more money than most other participants. Following their actions can help us make money. Lars Tvede explains that institutional investors can be divided into three types. 1. Top executives holding over 5% of a listed company's shares. If senior executives of a listed company are selling a large number of company shares, it may indicate that they need cash, possibly to improve their personal financial situation. However, it is more likely that they are aware of problems within the company, making this a risky signal. On the other hand, if company executives are buying a significant amount of company shares, it suggests that they believe the company's stock is undervalued or that the company has a promising future. Since executives know the company best, their actions can carry significant weight. 2. Major capital holders on stock exchanges. These are institutions such as social security funds, insurance companies, mutual funds, securities firms, and QFI, qualified foreign institutional investors. They are typically state-owned organizations or large commercial entities. Their actions can influence market ups and downs and the rotation of market trends. If data shows that they are selling a substantial amount of stocks, it indicates that the market is likely to decline. Conversely, if their selling volume represents only a small fraction of total selling volume, the market is unlikely to fall significantly. 3. Financial arbitrageurs. These individuals are the earliest to detect price changes and use financial trading to manage risks. They possess extensive market insights and can anticipate price changes. Why can financial arbitrageurs detect price changes early? Because many of them work in specific industries, such as iron ore, crude oil, or coal, as frontline industry professionals. When they perceive that the price of a certain commodity is about to decline, they sell futures contracts early to avoid losses for their companies. So, if you observe arbitrageurs selling, it is highly likely that prices will drop. These three categories of market influencers conclude our discussion. However, even professional investors, including institutional investors, can make mistakes and face setbacks. Why does this happen? Because while information is crucial, mindset determines everything. Next, we move on to the third part of the content: how investor psychology influences stock market movements, both up and down. Psychology represents hidden needs and desires that we may not even be aware of ourselves, yet it significantly impacts our actions. Lars Tvede points out that both professional investors and retail investors can be influenced by 4 types of psychological states in their trading behavior. 1. Regret. When the stock market has already risen, but you missed the opportunity to enter, strong regret can set in. People feel a sense of urgency to correct their previous mistake when they see even a slight price dip, often leading to impulsive buying. This is a common psychological phenomenon in the stock market. 2. Overconfidence. Some individuals subconsciously attribute their success in the stock market to their efforts rather than luck. Many investors become overconfident after making money in the stock market. They believe they possess superior investment skills. Under this overconfident mindset, they become less cautious and trade more frequently. In the investment community, it's challenging to find frequent traders who consistently achieve stable returns. 3. Adaptation. This psychological state involves going along with the crowd and conforming to the majority's opinions and actions. People are easily swayed by others' views and strive to maintain the same positions and actions as the majority. If others are buying, they buy. If others are buying at a certain price, they buy at the same price. For self-defense, when individuals' actions result in outcomes contrary to their initial expectations, they are less likely to admit their mistakes. Instead, they tend to ignore or misinterpret uncomfortable information and actively seek comforting information that aligns with their interests. For instance, when experiencing significant losses in the stock market, individuals often avoid looking at their stock portfolio and are reluctant to open their accounts to see the extent of their losses. They are also less inclined to hear unfavorable news and tend to refrain from trading. However, when positive news surfaces, they become attentive and may even start trading. These 4 psychological states conclude the discussion of investor psychology. According to Lars Tvede, both upward and downward trends in the stock market are driven by these psychological states. Now, let's examine upward trends. When a stock market begins to rise, many people are initially uncertain and hesitant to enter the market. However, there are always early birds who perceive the opportunity and enter first. As the stock price gradually accumulates gains, most investors start regretting not having entered earlier and eagerly hope for a price drop to follow the big players. When the stock price slightly retreats, they rush in, leading to a buying frenzy that further drives up prices. At this point, stock analysts take notice, and more investors join the market, following the prevailing sentiment. As a result, stock prices continue to rise. Listed companies secure funding from the stock market, which they use to invest in the real economy, promoting economic growth. A flourishing economy, in turn, supports the stock market, maintaining the upward trend. Eventually, there is a scarcity of sellers, and everyone only hears the bull market's roar, maintaining a consistent buying action. The continuation of an upward trend can be assessed using 2 simple methods as summarized by Lars Tvede. 1. Examining previous high-volume areas. A high-volume area refers to a price range where daily candlesticks stayed for some time, and trading volumes were relatively high. As long as the price does not drop below a previous high-volume area, the trend remains intact. If the price falls below this level, it's a sell signal. 2. Analyzing chart patterns. If the previous tops continue to serve as the bottoms in the trend, the uptrend is likely to persist. Conversely, if price movements no longer form higher tops and bottoms, the trend is likely to reverse. Now, let's shift our focus to downward trends. In a bull market, fueled by positive sentiment, everyone rushes in with full positions. However, when stock prices start to fall, especially when portfolios are deep in the red, individuals experience immense psychological pressure. Under this pressure, a change in attitude can occur in just a few hours, minutes, or even seconds. People begin to believe that market prices are too high and anticipate that the downtrend will persist. This results in new selling pressure, which drives the market further down. Continuous declines lead to group panic as investors follow the behavior of others, amplifying the downward spiral. At this point, bearish sentiments dominate, and other voices are drowned out. If the psychological basis of a bull market is regret for not entering earlier and wanting to profit more, then the psychological foundation of a bear market is the aversion to losses. So, have the stock markets fallen enough? Will the downward trend continue, and how can we determine this? According to Lars Tvede, during a trend, as long as the tops continue to break below previous bottoms, the downward trend will persist. This means that as long as price movements do not form higher tops and bottoms, the market will likely continue its downward trajectory. In addition to chart analysis, trading volumes are a crucial tool for evaluating market trends. Despite the abundance of superficial information in financial markets, trading volumes reveal the truth. Bull markets typically have higher trading volumes than bear markets because people's attitudes toward gains and losses are different. In bull markets, people attribute their gains to their skills and trade more frequently, leading to significantly higher trading volumes. In contrast, during bear markets, driven by self-defense psychology, individuals tend to hold on to their stocks, hoping for a rebound, resulting in lower trading volumes. So, in theory, you now understand how to assess market trends. How to use trading volume to guide your actions specifically. Lars Tvede outlines 2 simple methods. First method. If a stock opens with significantly high trading volume and its opening price differs from the previous day's closing price, the trend for the day usually tends to move toward the previous day's closing price. The reason behind this is that the substantial trading volume at the opening is often driven by overnight news, and this news is already fully reflected in the opening price. Subsequent price movements tend to align with the direction of the previous day's closing price. Second method. In general, the larger the trading volume, the stronger the support level. The support level is the price level at which a stock typically doesn't fall below. When you observe a stock experiencing a significant volume increase while rising, the price level of the previous high points is often the current support level. This price level is unlikely to be breached, so buying at this support level is relatively safe, and you are less likely to get trapped. While there are various technical indicators that can serve as decision-making tools, Lars Tvede emphasizes that, overall, the market is influenced by people's perceptions and emotions. To recap the main points covered in financial psychology. 1. Initially, we discussed the 4 fundamental principles of the financial market. 2. Then, we introduced the 3 most valuable types of market information. 3. Finally, we elucidated the psychological mechanisms behind stock market trends, both upward and downward. People often believe they have learned valuable lessons from financial crises, yet they repeatedly find themselves in crisis situations. The underlying reasons for this phenomenon are rooted in human nature and emotions. Lars Tvede concludes by reminding us that it's important to listen to what the market is saying rather than just following the voices of other investors. That wraps up the content of the book on financial psychology. Congratulations on completing another book. Thank you for your support and attention. Please subscribe to the Tim Booker channel, like, and share this valuable knowledge with your friends. Let's combine wisdom with practice to achieve our financial goals and create a better future. Thank you all, and goodbye.